All right, welcome today to Tackling Tax Basics. This is our first 2025 webinar of the Get Savvy, Grow Your Green Stuff webinar series. We've been running it all academic year, but this is the first of the 2025 calendar year. My name is Andrea Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system. And I am joined today by two of my colleagues from Geese College of Business. So, Mandi, do you want to introduce yourself?
Yes, thank you, Andrea. My name is Mandi Alt. I am an instructor in the Geese College of Business. I teach tax, advanced tax, and intro tax. And I also run the university's VITA program, which is a volunteer income tax assistance program for qualified individuals.
Thank you so much, Mandi. Kathy has been on this series for a long time, but she is specifically with Geese College of Business today. Kathy, do you want to talk a little bit about what you do with Mandi?
Yes, thank you. I am Kathy. I have been in financial education for several decades. And this year I am working with VITA, which is our free tax service for eligible community members. And we partner with Salt and Light. And we're looking forward to the kickoff of our site on February 1st.
And we are extra thankful for Mandi and Kathy being here today. And I'm just going to go through a few of the things that we normally do during the beginning of our webinars. So collectively, the Get Savvy webinar team represents organizations across the state of Illinois, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations. And we have a responsibility to acknowledge these Native nations and work with them towards a more vibrant and inclusive society. So we also are going to use a couple polls. I'm going to launch a poll to see who is joining us today. It may be quite a bit different from what we anticipated when you registered. So we're going to launch that demographics poll. Just gives us a little bit of information about how old our audience is, or how young, how youthful you are, whether you're a student or full-time employee, kind of the gender distribution as well as race and ethnicity. That also helps some of our partners kind of understand who is joining our collaborative events with them, and it helps us identify maybe what to emphasize in some of our programming both now and in the future. So if you can respond to that, be very helpful. So it looks like about 60% of you have participated. That is quickly going up, so we appreciate the participation. All right. We have people here from across all age groups from 18 to over 75, which is great. Everybody has to pay taxes, so that makes sense, all adults anyway. We have mostly students on, but we also have several full-time employees and part-time employees. Lots of female and male participants, and a pretty diverse group regarding race and ethnicity. So I'm going to end this poll and give it a couple more seconds. All right, I'm ending the poll. I'll share the results real quick so you can see who's all joining us today. And I'm also going to stop sharing. So if that demographics poll results is still up, you can exit out of it. And the next poll that we do should pop up for you. So don't worry too much about it. I also want to highlight this disclaimer. Mandi Alt and Kathy Sweeler are here as our tax experts, but answers to individual questions may be limited. It's generally against University of Illinois policy to provide tax advice or financial advice to any individual, but we'll be going over a lot of information that will be helpful for filing taxes this year. This presentation will cover really basic key terms, items needed to file, the layout of a tax form, and some of the steps to file, as well as resources. You may need to hire a tax professional for questions specific to your situation if you haven't already hired one. So just keep that in mind. Like I already kind of went over when we were talking about the disclaimer, here are some of the learning objectives that Mandy is going to help us out with. So we want you to be able to understand your income tax liability, identify how to pay your taxes. We also will talk about how to recognize unique considerations for students, since that's the majority of who we target with our outreach. We'll also discuss a few things regarding state obligations and summarize resources that you can use to file. And I say we kind of generally, but we really mean Mandy. Mandy's the star of the show today, and I'm going to hand it over to Mandy to talk about income tax responsibilities.
Perfect. Thank you, Andrea. I will be walking you through today those learning objectives that Andrea talked about, and hopefully by the end you feel a little more comfortable with your income tax filing responsibilities. We're going to start just generally talking about what is your responsibility to file and pay income taxes. The broad answer to that is if you have income, you have to pay tax. So, Andrea, if you would want to go to the next, thank you. So basically, most income is taxed. There are a few exceptions to this, but generally speaking, if someone has income in the U.S. or if you're a U.S. citizen and you have income anywhere in the world, you have to pay tax on that. So, what is taxable? Obviously, your wages from your job are taxable, your investment income, retirement income is taxable. Sometimes people question that, but if you were receiving retirement income like pensions and annuities and IRA distributions, those things are taxable. There are just a few things that are not. So the tax law says if it's not one of these few things, obviously we don't list everything here, but if it's not specifically listed in the tax law as not taxable, then your income is taxable. So what is not taxable? If you receive a gift, if it's truly just a gift from a family member or a friend, someone who's doing this just because of their relationship with you, that's not taxable. If you receive child support, that's not taxable. If your employer or someone else is reimbursing an expense that you incurred in your duties, not taxable. There are some forms of education assistance, some scholarships and things like that that are not taxable. We're going to talk a little bit more about that later, but there are a few times when receiving assistance for your education expenses would not be taxable. If someone dies and you receive life insurance proceeds because that person died and you were the beneficiary, that's also not taxable. But generally speaking, any type of income that you receive is taxable. And that is true whether you receive a tax form or not. Sometimes it is a common misconception if I don't receive some sort of a tax form, then I don't have taxable income, and that's actually not true. One example of that, this is probably the most common example, is if you do contract work that the person pays you or the company pays you less than $600, they don't have to provide you with a tax form that says they paid you that money. And people often think that that means that it's not taxable. That's not true. If you do any kind of work and you get paid for it, whether you get paid in cash or any other form, that's taxable, whether or not you receive a tax form. Okay. So most of your income is taxable. A few things maybe are not taxable, but you're responsible for paying tax when you have taxable income. We're going to talk about how you actually pay that tax in a minute. But anytime you have income, you have to pay tax on that. All right. So do we pay tax on all of our income? Gross? Do we take all of our income and pay tax on that? The answer is no. We get to reduce that amount, our gross income, we call that. We get to reduce that by something we call a tax deduction. So these are our expenses that you would have, things that you would pay for that the tax law says you can actually reduce the income that you pay tax on by these amounts. We call that a tax deduction again. And we're, as you can see, we're just kind of working our way through this formula to calculate how much tax do I have to pay. The starting point being, here's all of our income. Now we're going to reduce that by certain tax deductions. So you get tax deductions for things you pay for. Most things you pay for are not tax deductions. So for example, if you pay your utility bill, that is not a tax deduction. If you pay your rent, that is not a tax deduction. But there are a few things that the tax law says we can reduce, we can use as a tax deduction. So what are some of those things? Some of those things would be medical expenses as long as they're over a certain amount. Interest and taxes that you pay related to owning a home. So if you own your home and you pay property taxes, that's a tax deduction. If you own your home and you have a mortgage and you pay mortgage interest, that's a deductible expense. Another thing that's deductible is if you pay taxes to a state or local government. So when you pay your state income tax, you get a tax deduction when it comes to calculating your taxable income for federal tax purposes. When you pay for again, property taxes on your home, that's a tax deduction. So some state and local income taxes that you pay, or some state and local taxes that you pay, are going to reduce your income that you pay tax on when it comes time to pay your federal income tax. Another common tax deduction is charitable contributions. So if you donate money or any kind of property, anything of value to a charitable organization, then you can get a tax deduction for doing that. So the tax law lists these specific things that you might be paying for that you are allowed a tax deduction for. But some people don't have a lot of these things. Or maybe they have, for example, medical expenses, but there's a threshold. You can only deduct those if they exceed a certain amount, and the medical expenses might not exceed that amount. So if you don't have a lot of these, what we call these itemized deductions, if you don't have a lot of them, then the tax law actually sets this what we call a standard deduction, and this is just a set amount. So every taxpayer gets at least this amount, this standard deduction amount of deduction that we're able to reduce our taxable income by. And what amount that is depends on what we call your filing status, which we're going to talk about in a minute. Your filing status will dictate how much of a standard deduction you get. So again, if you have a lot of these itemized deductions that we talked about, then you would use those. If you don't, then you would use the standard deduction. You get to use whichever one is bigger. So standard deduction amount, for example, if you are single, that means you're not married, would be $14,600. So you would take your income that you received, all of your income, minus $14,600, and that would be your taxable income. Okay. Your taxable income is going to be the amount of income. That's your net income for the year that you're going to pay tax on. You'll use that amount. You'll apply tax rates. We'll talk about that in a minute. But that is the amount of your net income you're going to pay tax on for the year. So the more tax deductions you have, the lower your taxable income, and then the less tax you're going to pay. All right, so one thing we didn't talk about, I was wanting to keep it a little simplified when I was talking about deductions to start with. But one thing we need to talk about is this concept of adjusted gross income. So again, we have your gross income, that's all of your income from all of the sources that you have, and then we subtract your deductions, and that gives us taxable income. But your deductions are actually broken into two types. We have two different types of deduction. So we have what we call itemized deductions. Those are the ones we were just talking about that are medical expenses and taxes and charitable contributions. Those are what we call from AGI deductions. So you're going to sum up all of those, compare it to that standard deduction, use whichever one is bigger. That is what a lot of people think of when they're thinking of tax deductions. But there's this whole other group of tax deductions called for AGI deductions, and they're different things. They're things like if you contribute money to a traditional IRA, or if you have a health savings account and you contribute money to that. There are some tax deductions that get special benefit, and the benefit is that they are what we call 4 AGI deductions. They are deducted when determining adjusted gross income. So we take our gross income minus these 4 AGI deductions to get to adjusted gross income. Then we subtract our itemized deductions or standard deduction to get our taxable income. Why is that important? There's two reasons. One is that adjusted gross income is something that is a measure that's used to determine if you're eligible for certain tax benefits. It's also something that's used to determine if you are subject to certain tax penalties, additional taxes, things that we don't always like. So the lower your adjusted gross income, the better. Another reason why the adjusted gross income and the deductions that we're able to deduct to arrive at that are important is that we talked about the itemized deductions and how we compare them to the standard deduction. We will not have to include these 4 AGI deductions in that analysis. So we get to use those and also the greater of either our standard deduction or our itemized deductions. But ultimately, what we're trying to do is we're trying to calculate the net amount that we have to pay tax on for the year. And we're going to do that again by taking all of our income sources and subtracting all of the deductions that we're allowed to deduct. And then we get our taxable income. All right, if you want to, thank you. So taxable income is what we pay tax on. Again, we take our gross income minus our deductions, that equals our taxable income. But there is one other thing that we have to talk about before we can talk about how much tax are you going to pay, and that is what is your filing status and who are your dependents. So filing status and dependents are two very important concepts in the tax law. They determine a lot of different things, and a taxpayer has to determine what is my filing status, who are my dependents before we can go any further kind of in this analysis. So what is your filing status? Filing status depends on, are you married or are you not married? There are a few filing statuses that also depend on, do you have dependents or not? Your filing status is, for example, single if you are unmarried and you don't have any dependents. Your filing status is head of household if you are unmarried but you have dependents living with you. Your filing status is married if you are legally married, or your filing status could be qualifying widow or widower if your spouse has recently died. So there are these different filing statuses. Some depend on the presence of having a dependent, and some do not. The filing status is important because it's going to determine the tax rates that you pay. It's going to determine the amount of your standard deduction. So we talked about that standard deduction. We said the amount of that is dependent on what is your filing status. Filing status also determines, in some cases, the threshold for when do I qualify for this specific tax benefit, or maybe a threshold of, do I have to pay this extra tax or not? Or will I have this tax penalty? Or maybe, do I qualify for this tax credit? That's something we're going to talk about in a minute. So filing status often determines a lot of things related to how you file and pay your taxes. Again, filing status is primarily dependent on, Andrea, I'm sorry, if you could go back just one more. I'm kind of jumping around in the order a little bit here, so I apologize. But again, filing status is dependent on your marital status, but it is also dependent sometimes on do I have a dependent or not? Dependents are people who are one of two categories. Either it is children who live with you, or it is anyone who you have some relationship with that is financially dependent on you. So there are tests, there are two different sets of tests. You kind of have to walk through each of those to see if someone is going to be your dependent or not. But it's generally speaking, people that you're responsible for, either physically responsible for or financially responsible for. Okay, perfect. Next slide. Okay, so like I was saying before, the first step is to filing and paying taxes is to calculate your taxable income. The next step is to take that taxable income and calculate the amount of tax that you have to pay on that. And we do that by applying what we call what we call in the U.S. a progressive tax rate structure. And what that means is that your income is going to be taxed at progressively higher rates the more your income is. And when I say income, I'm now talking about taxable income. So remember, we took our gross income, we subtracted all the deductions that we were allowed, and now we have our taxable income. And the amount of tax that you're going to pay on that is determined by these tax rate schedules. We call this the tax rate schedules. And as you can see that those tax rates and the amount of income subject to that particular rate is going to be different depending on your filing status. So for example, if you have taxable income of $100,000 and you are single, then the way you calculate the tax that you pay on that $100,000 is that you are going to pay 10% on the first $11,600 of that 100,000 of taxable income. And then on the next 35,000 or so, so from 11,601 to 47,150 of that taxable income, you're going to pay 12% tax. And then on the taxable income from 47,151 up to that 100,000, your total, you're going to pay 22% tax on that. So this is what we call a progressive structure. You don't pay 22% tax on your entire $100,000. You get to pay 10% on the first little bit, and then 12% on some, and then 22% on the last 50,000 or so. All right, so now we've calculated our what we call tax liability. So we started with our gross income, all of our sources of income that we've received that year, unless they are excluded by some specific tax law that says you don't have to pay tax on that. And then we subtract our deductions. Remember, we have two different kinds of deductions. We have 4 AGI deductions that we get to subtract regardless. And then we have from AGI deductions, we're going to take a look at those specific from AGI deductions called itemized deductions. Again, those were the things like medical expenses and charitable contribution and interest and taxes. You're going to compare that to your standard deduction, that set amount based on your filing status, and whichever is bigger, you're going to use that. But ultimately, what you've just done then is calculated your taxable income. And then you're going to apply those tax rates. So again, remember, you have to figure out what is my filing status, and that's going to tell you which of those tables to use, which tax rate applies to you, and you're going to calculate your tax. You now have what we call your tax liability. That's the amount of tax that you owe, except that the IRS, the tax law gives us some tax benefits that we call tax credits that we can use to reduce this amount so that we don't have to pay as much. So tax credits are provided in the tax law for things like having dependents. So if you have a dependent, you get a tax credit for that dependent. How much that credit is depends on what kind of dependent it is and how old they are. If you pay for childcare expenses so that you can work, if you pay those expenses for your dependents, then you get a tax credit for that. That's going to reduce your tax liability so that you don't have to pay quite as much. If you pay for tuition, sometimes you can get a tax credit. If you are someone who has very low earned income, so you're working, your income comes from a job, but your income is low, the tax law will give you a tax credit, and that helps subsidize your income if you're in that situation. So a tax credit and a tax deduction are both going to be tax benefits for you. We're now going to take a little quiz that's going to test your understanding of those two things because they're not quite the same. So I'm going to hand it over now to, I believe, Kathy or Andrea, I'm not sure.
I just launched the quiz. So it's a tax credits versus a deductions quiz. Hopefully it all popped up for you. Once you have selected each option that you can, I believe it's submit allows you to see if you are correct or not. So we have about 10% of people have participated. So the types of questions on this quiz are, what does a tax credit do? Does it A, reduce your taxable income, B, directly reduces the amount of tax you owe, or C, reduces your gross income? True or false, a $1,000 tax deduction will lower your tax bill by exactly $1,000. So those are your options, true or false. And which provides a greater benefit if the amounts are equal, a $1,000 tax credit or a $1,000 tax deduction? So it looks like about 65% of people have responded so far. And I know we're getting a lot of questions in the chat, some of which we can provide some guidance on, some of which we are limited to. All right. So we have about 75% of people that have participated. I'm going to give you about 10 more seconds to respond, and then we'll end the poll and share the results so that Mandi can tell us where we might have some misconceptions about credits versus deductions. All right, I'm going to go ahead and end the poll and share the results. So hopefully you can see the correct answer now if you didn't already for each one of these. Mandi, can you see the results, and do you want to talk
I
about?
can.
All
Yeah.
right.
Yes. All right. So, first question, what does a tax credit do? And we had the options: reduces your taxable income, directly reduces the amount of tax you owe, or reduces your gross income. The correct answer is that a tax credit directly reduces the amount of tax you owe. So if you have a taxable income, and you've calculated your tax liability using those tables, a tax credit is going to allow you to reduce that tax liability dollar for dollar. So a tax credit directly reduces the amount of tax you owe. The second question, a $1,000 tax deduction will lower your tax bill exactly $1,000, is false. So a tax deduction does not work the same as a tax credit. So we just said a tax credit is going to reduce your tax liability dollar for dollar. A tax deduction does not. What a tax deduction does is it reduces your taxable income. So a tax deduction of $1,000 is going to reduce your taxable income by $1,000. But remember, when we are calculating the tax we owe, the tax bill, we're calling it in this question, we actually take that taxable income and we apply those tax rates. So if you're someone who's in the like we just talked about it, that single person, $100,000 of taxable income, and we said that last $50,000 of their taxable income was going to be taxed at 22%, right? We remember that example we just talked through. If that person had a $1,000 tax deduction, that would reduce their taxable income to $99,000, but they are going to pay tax at a rate of 22% of that. So now instead of having $100,000 taxed, part of it taxed at 22%, now we've got $99,000 and part of it taxed at 22%. So we've just saved ourselves, our tax bill would be reduced by 22% of $1,000, not $1,000. Okay, hopefully that makes sense. The last question, which provides a greater benefit if the amounts are equal, a $1,000 tax credit or a $1,000 tax deduction? The answer is the tax credit. So in the example we just talked through, we said if we had a $1,000 tax deduction, that was going to save us in taxes 22% of $1,000 in our situation, right? If we had a $1,000 tax credit, that would save us exactly $1,000. We would calculate our tax liability on the $100,000 of taxable income, and then we would reduce that amount by $1,000 if this was a tax credit. Okay, was that, hopefully that was clear.
Thank you. That was beautiful. I'll go ahead and stop sharing the results so we can move on. Thank you, Mandi.
All right, so how do we do all of this? We know now that we have to figure out what's our filing status, who's our dependents, what is our income, do we have any tax deductions, what is our tax rate that we're going to pay? We're going to calculate that liability, and then we're going to reduce that by any tax credits we're allowed. How do we actually do this? The answer is that partly we are making estimations of this throughout the year. We're going to talk about that in a minute. Most people who are just employees and have a job don't have to physically do that. It's being done for you. We'll talk about that in a minute. But at the end of the year, you have to look at, okay, I made all of these estimates of what this was going to look like, and now I have to figure out, did I do it right? Do I owe more money now, or does the government owe me money? Did I overpay? And so the way we do that is we file a tax return. So at the end of the year, we file Form 1040, and we calculate through this form everything I just talked about. So this form is what walks through that tax formula that we were just talking about, where you summarize, here's my income, you report, okay, here are the deductions I'm allowed, here's my taxable income, and now I'm allowed these tax credits, so I owe this much tax. This is how you report all of that to the IRS, and then figure out, have I paid enough or do I need to pay more? All right, so what do I mean by have I paid enough? Do I need to pay more? Do I get some back? We have what we call a pay-as-you-go system. So taxpayers cannot wait till the end of the year, calculate their gross income minus deductions, all of this business we've been talking about, and then pay that amount at the end of the year. Our system requires that we make estimates of what we're going to owe and pay it throughout the year. So if we have that taxpayer with $100,000 of income, of taxable income, they cannot wait until the end of the year and calculate their tax, some of it at 10%, 12%, 22%, subtract any tax credits, and then say, okay, my tax liability after all my credits is, whatever it would be, $5,000. So I'm going to write a check right now and pay $5,000. We know that's not how it works. If you're working, you know that's not how it works. And the reason that's not how it works is that the tax law requires that we pay that $5,000 throughout the year and not wait until the end of the year to pay it. How we actually do that is one of two ways. If you are an employee, and that's where most of your income is coming from, your job, your employer is required to withhold taxes from your paycheck. So every time they give you a check, part of that $100,000 of taxable income, every time you get some of that, you're not getting the whole amount. You're getting the employer is saying, okay, this paycheck this time was $5,000, but based on the calculators that the IRS provides us, our estimate of this person's tax on this $5,000 we're about to pay them would be $1,000. So we're going to give them $4,000, the employee, and then the other $1,000 we're going to send to the IRS, and the IRS is going to hold that in an account for that employee. And then at the end of the year, you're going to report to the IRS, okay, I know my income was 100,000, and I know now that my tax liability is this amount, but I've already paid to you $1,000 every time I got one of those $5,000 paychecks. 1,000 of it already went to the IRS to prepay these taxes. So I'm going to report, I've already paid you $12,000. And then the tax return that we just looked at, the Form 1040, then is going to take that amount, the tax liability you've now calculated at the end of the year, and compare it to the amount you've already paid throughout the year through these tax withholdings. And whatever the balance of that is either what you have to pay now, what your tax due. If you didn't pay enough throughout the year, you have to pay the rest now. Or if you paid too much, you get the excess back. So that would be a tax refund, we would call it. So that's a lot of people, that's how they pay their tax. Their employer withholds amounts from their paycheck, they send them to the IRS, and then at the end of the year, you're filing your tax return to reconcile. Did I pay too much or not enough? Do I owe the IRS more money, or are they going to owe me a refund of some of what I paid? If you have income for which withholding is not happening, again, employers are required to do this kind of tax withholding. Other people who pay you for work you do, like if you're a contractor, they are not required to do that. So you have to do that on your own. Contractors, people that own businesses, people that have significant amounts of investment income, and retired folks have to do this process on their own, where they are estimating throughout the year, how much do I think I'm going to owe, and prepaying that. They don't have to do that every single time they receive some money. They have to do that quarterly. So 4 times a year, you have to make an estimation of what you think you're going to owe and pay that amount, or 1/4 of that amount, on a quarterly basis. All right, so understanding your net pay is something that I think is very confusing. We've just set the stage for this just a minute ago. What happens when you are an employee, again, is that your employer has to withhold tax money from your paycheck. So when you receive, when you start a job and your job is going to pay you $5,000 a month, you already know you're not getting $5,000 check at the end of every month. That's what we call your gross pay. The amount your employer has agreed to pay you, that's your gross pay. Sometimes your employer is paying for things on your behalf that is included in your taxable pay. So some things your employer pays on your behalf are not taxable part of your gross pay, and some things are. So for example, if I start a job and my employer says, we will pay you $5,000 a month, and every month we will pay for your health insurance, and also every month we will pay for your gym membership. The $5,000 that they're going to pay me and the gym membership are both taxable. The amount they pay for my health insurance is not taxable. So your employer is going to take your $5,000 plus the value of your gym membership. That's your taxable pay. And from using a calculator that the IRS provides, and also using the information you report to the employer about things like your marital status, how many dependents you have, the employer is going to calculate the estimate of what your tax liability would be. They're going to send that estimate of your taxes to the IRS, and you're never going to see that. So when the employer says we're going to pay you $5,000 a month, and then at the end of the month you get a check for $4,000, That's what we call your net pay. And what's happening is they are estimating how much tax you owe on that gross pay plus your taxable benefits, and they are withholding that and sending it to the IRS. All right, so how do we know what the whole end result of all of that process is? The employer will give you at the end of the year a form called Form W-2. Form W-2 is going to tell you, here are your taxable wages. That's what you're going to see in box 1. That's the amount of your pay from your employer that you have to pay tax on. And then in box 2, they're going to tell you, this is the amount that we withheld from your paycheck and sent to the IRS on your behalf for your federal income tax. And you're going to use this information to complete that Form 1040 tax return that we talked about. In a minute, we're going to talk about state filings, and you can see at the bottom of Form W-2, they're going to tell you the same thing related to your state income tax obligation. Here's your taxable wages in box 16, and in box 17, here's how much state tax we withheld and sent to the state for you. This is Form W-2. You're going to get tax forms like this really from most entities that pay you money. Your sources of income, most of the time, not all the time, have some sort of related tax form that you're going to get that's going to report to you the information that you need to be able to complete your Form 1040 tax filing and do this whole process of reconciling how much income do I have and all of those things. All right. So just to summarize, your tax filing obligation starts when you receive income. If you receive income and you are physically in the US or you are a citizen of the US, you have to pay tax on that. And the amount that you pay depends on a lot of things. You're going to summarize all of those sources of income from your job, your investments, your retirement income, your contract work, anything that's taxable. You're going to add all of that up. Then you're going to subtract your tax deductions. We know there's different kinds of deductions and different thresholds and limits and things like that that you have to apply. That's going to be your taxable income. And then you're going to apply the tax rates based on your filing status to get your tax liability. Your tax liability then can be reduced by any tax credits that you are due, and then also by the prepayments that you've already made. And in the end, whatever the end result is, if you have a positive amount, so if your tax liability exceeds your tax credits and prepayments, you'll have to pay that extra amount at the end of the year. If that result of all of that is negative, that means you already paid too much and you might get a refund. And when I say might, that depends on, was that amount negative because of a tax credit or because of a prepayment, and what kind of tax credit? So if you have a refund to do, but it comes from a certain type of tax credit, then you might not get a refund. We call those non-refundable tax credits. But if you're negative, the result of all this is negative because of a refundable tax credit or because of your prepayments you made, then you're going to get that money back. All right, so what do we need to know about state taxes? So what we've been talking about so far is related to filing your federal income tax. But most states in the US also require you to pay an income tax. So what do we need to know about state taxes? The biggest thing is that you have to pay state income tax on income earned in that state for the most part. How we do that in Illinois is that we start with our federal adjusted gross income. Remember, we talked about we take our gross income minus certain deductions to get adjusted gross income. That's the starting point for paying tax in Illinois. Not every state is the same. This is just how it works in Illinois. You are going to take that federal adjusted gross income and you are going to reduce it by some deductions. There are not very many, but there are some tax deductions that you're allowed in Illinois. For example, if you have included in that income, that federal gross income, if any of that is from retirement income, you do not have to pay tax on that in the state of Illinois. So you can reduce your federal adjusted gross income by any retirement income that's included in there. And then you're going to pay tax in Illinois at a flat rate. So whatever your taxable income ends up being, actually, I forgot to say there is, Illinois calls them exemptions, but it's kind of like the standard deduction. Everyone gets a set amount per person. So the taxpayer's spouse, and every dependent gets a set amount of deduction for Illinois, and you can reduce your taxable income by that. Then whatever your taxable income is taxed at a flat rate of 4.95%. State of Illinois' tax rate is 4.95% on all of your taxable income. There are some tax credits that you can get to reduce that. There is a credit when you own a home and pay real estate taxes. There's a small credit you can get to reduce your Illinois income tax that you owe. If you are a teacher, a kindergarten through 12th grade teacher, there's a small tax credit when you buy classroom supplies. Those are the major ones, but there are a few other tax credits in Illinois. All right, so one of the biggest questions we get, this is a kind of a transient community here in Champaign-Urbana, and so we get a lot of questions on, am I a resident or a non-resident for filing in Illinois? For anyone who is maybe an international student, you'll know there's a big concept. If you're not a US citizen, there is a you have to determine if you are what we call a resident alien or a non-resident alien. Those are just the terms the tax law uses. That this is different. This is not the same as that. We're going to talk about that in another webinar, so we won't hit on that now, but that I bring that up because it's not the same thing. Illinois residency, the way you file tax in Illinois depends on where was your physical permanent home during the year. If you physically were in Illinois the entire year, permanently here, you are a resident of Illinois for tax filing purposes. Again, this also has nothing to do with in-state, out-of-state tuition. This is one factor in it, but this is not the same thing. Illinois income tax, you are a resident if you've lived here all year. If your permanent residence was somewhere else, even if you physically were here, let's say your permanent residence is at home in another state with your parents, and you are just here for school, you are a non-resident. You would pay tax in Illinois if you had income in Illinois, but you're a non-resident. Residents have to pay tax on all of their income that's sourced in Illinois and their investment income. Non-residents pay tax only on income you earn in Illinois. That also, what is meant by Illinois sourced income is beyond the scope of this, but generally speaking, if you work in Illinois, you're going to pay Illinois tax. If you are a resident of Illinois and you have any kind of investment income, you're going to pay Illinois tax. Okay. The other option is a part-year resident. You could be a part-year resident of Illinois, and that would happen if you lived in another state for part of the year, but you permanently moved to Illinois at some point during the year. Now, again, when I say permanent, I don't mean that you have to be here forever. I just mean you packed up your household and you moved to Illinois versus your household is still in this other state and you came here and rented an apartment for a period of time. That's what we're talking about. So in Illinois, there's 3 different ways to pay tax. You can pay tax as a resident, as a non-resident, as a part-year resident. And the process or what is different in terms of those things mostly has to do with what income is taxed to you in Illinois, and then some tax credits. All right, other states are different. So there are some states that don't have an income tax. Texas, for example, does not have an income tax. There are other states that tax very broadly, and their definition of what income is taxable in that state is pretty broad. California, Ohio, New York, and Illinois tend to be the worst, to be honest, in terms of paying tax like inclusively. But every state's slightly different. If you have a lot of state tax issues, I would definitely recommend seeing a tax professional to help with that. But generally speaking, in Illinois, you're going to pay tax on all your income if you're a resident. You're going to pay tax on any income you earned in Illinois, regardless. All right, so since a lot of you are students, we're going to share just some common things that impact students. And the big question I actually saw in the chat was, are fellowships taxable? We're going to get to that in a minute. All right, so when you are a student, you also often get support for your educational activities in a variety of different ways. Any education assistance that you receive, it does not matter where it comes from or what form it's in. The general rule is that if you were not required to perform services to receive it, and the support was used to pay for qualified education expenses, then it is not taxable. And if it does not meet both of those criteria, it is taxable. So I think the next slide, Andrea. What is a qualified education experience? So the first question, or the first caveat is you cannot exclude education assistance if you were required to perform services. So if you're given, for example, a tuition waiver and you're required to be a research assistant in exchange for that, you're going to be taxed on that tuition waiver above a certain amount. There is a limit, there's an amount that your employer can provide for tuition assistance specifically. It's $5,250. That's not taxed, but anything else is going to be taxed. And if your employer provides you anything besides a tuition waiver, obviously that's going to be taxed. You're working, you're doing a job, you're going to get taxed on that income. That's the first criteria. That's one that people tend to understand. The second criteria is what catches some people off guard. So in order for educational assistance, anything you receive while you're a student, to be tax-free, the first caveat is you can't be required to perform services for it. The second is that it has to be used for qualified education expenses. And qualified education expenses are your tuition, the required fees that the university charges you, not optional fees like I think the recreation facility fee is optional. That's not a required fee. And required book supplies and equipment. So if your program of study requires you to purchase certain books, maybe supplies. My son is a PhD student and he had to purchase lab supplies, protection, and things like that. That was required for him. Things that are required. It's not things that are optional. So if you buy a laptop because that makes your life easier, that's not a required expense. If your program requires you to have a laptop, that would be a required expense. But what is the most confusing and the most surprising for students often is if you use a fellowship, a grant, a stipend, anything that you receive as part of your educational endeavor, if it is used to pay for room and board, food, research expenses, travel, including conference travel, anything that's not tuition, fees, books and supplies and equipment, it's taxable. Okay, that ends up being the shocking thing to people. So if you are a grad student and you are getting a tuition waiver and a stipend, the amount of that is used to cover your tuition, or the amount of tuition you're not being required to pay, is not taxable, but the amount that is covering your rent is taxable. Okay. So the other things to know about education assistance, you may or may not receive a tax form. So some common ways you know about this taxable education assistance is if you get your Form 1098-T, you're going to be able to see how much did I get in scholarships and grants, how much did I pay in tuition. We're going to look at that in a minute. But if you get, for example, some sorts of fellowships, I know there is no that doesn't show up on your Form 1098-T, usually because it didn't go through the University Financial Aid Office, but it's still taxable. You may not have received anything other than a check. Maybe you got a letter or something like that, but it's taxable. It's up to you to keep track of that, to know that amount, and to report that at the end of the year as taxable, unless it was used to pay for your tuition. Another thing to know is that you may not receive this money by cash or check. So some students are surprised by the amount that's being reported as their scholarships and grants on their Form 1098-T, because when they do the math, they say, okay, here's the amount that's being reported that I received, minus I know this amount went to pay for the tuition. But when I was getting my checks every month, it doesn't total up to this extra amount. And the reason for that is that the universities are usually taking out some of your required like fees and things like that uh, from the check before they give it to you. And some of those things, like we said, are required fees. They're qualified education expenses, and they're going to show up on your Form 1098-T as such. And some of those expenses are not, and they won't show up there. And so there's going to be maybe a gap between that difference of scholarships minus tuition and fees and what you actually received in your bank account. It's not always easy to reconcile that, but it is possible to do that with all of the information. So what I typically recommend is that students do a reconciliation of, okay, here's the total amount I know I received in scholarships, grants, what have you. Here's my tuition and required fees. Here are my optional fees. You can get that through your student services account. And then here is the amount of the actual cash, the checks that I got that were deposited. You can reconcile it that way if you have all of the information. It's just you have to pull that from a lot of different sources. Okay, so I've been referring to Form 1098-T. If you're a student and you've seen this, you've probably seen this before. If you're not a student, you might be confused about what I'm talking about. If you're a first-year student, this is probably where you need to pay attention the most. This is Form 1098-T. This is something that is going to report this is something the university would provide to you. Just a side note, if you are a University of Illinois student, most of the time, I don't believe these are printed and mailed to you. Typically, they're found in your student services account, so you can download it through that. Sometimes students don't know it's there. They've missed an email or something, but just know that you can get it through that. This is going to report in box 1 the amount of tuition and qualified expenses that you paid to the university. And in box 5, it's going to report the amount of scholarships and grants that were processed through your university's financial aid department. This doesn't mean that's the only scholarships and grants you received. It's just the ones that came through the university. It's your job to add up all of the scholarships and grants that you received, the ones that are included on here in box 5, plus any that are not, and subtract from that the amounts of qualified expenses that you have. So again, tuition and fees are going to be in box 1 on this form, but things like required books, supplies, and equipment are not going to be on here. So typically what this looks like is a student will get this form. They will take the amount in box 5. They will add to that any scholarships, fellowships, or grants that didn't come through the university. Maybe your employer gave you a scholarship, or maybe you got one from, some small like organization and it came just in a check directly to you. You have to keep track of those. Add all of that together. Then you're going to subtract from that whatever is reported here in box 1, and then also any required book supplies and equipment that you paid for on your own. The difference between the two, if it's a positive, meaning if you received more scholarships, grants, and fellowships than what you paid for tuition, required fees, required supplies, books, and equipment, then that amount is taxable. And the difficult part is that amount is taxable, and it has not had any taxes withheld from it. So remember when we talked about if you have a job, they're paying you $5,000 a month, they're going to withhold $1,000 for your tax. That's a prepayment of the tax you owe on that, so that when you get to the end of the year, you're not going to have to pay all of that amount at the end of the year because you've been paying it throughout the year. That's not happening with scholarships, fellowships, and grants. So if you have a large stipend, a large fellowship, you can end up needing to pay a lot of tax at the end of the year if you're not doing this reconciliation kind of throughout the year, just to kind of estimate, what do I think that I'm going to owe? All right, if you pay tuition and required fees, and in some cases books, you could get a tax credit. Now, what I want to start with is students who are getting these things paid for through scholarships, fellowships, and grants do not get to take these tax credits. This is if you're paying for these things either out of your own money or through a loan. If you pay them through a loan, that still qualifies for a credit. But if you received a grant or a scholarship that paid your tuition, you do not get these credits. There are 2 tax credits that you can get when you pay tuition and required fees. One is called the American Opportunity Tax Credit. That is a pretty large tax credit for students for their first 4 years of college. So it's usually not grad students, although if some students come in and graduate in undergrad in 3 years, so you could potentially be getting this credit as a grad student, but typically for undergrad students, and it is a credit for the amount of qualified education expenses. In this case, that is tuition, required fees, plus required books, supplies, and equipment. You can have up to $2,500 tax credit for paying those. The way you calculate the credit is it's 100% of the first $2,000 of expenses and 25% of the next $2,000. But you can, potentially receive a large credit. This is only a credit if you are not claimed as a dependent of someone else. So if your parent or guardian claims you as a dependent, they are actually the ones who get to take this tax credit, not you. And to be honest, it actually doesn't matter who pays the tuition. So that's a little bit difficult sometimes, but it's whoever is claiming that person as a dependent gets to claim this credit. Also, one thing that's not on the slide that I should note is there is what we call a phase out for this credit, meaning if your income gets to be above a certain amount, then you can no longer qualify for this credit. And that amount is fairly low, depending on your filing status. It's like $80,000, I believe, if you're single, and $160,000 if you're married. So a lot of people don't get this credit. The other credit that you could get if you paid tuition, and one thing I should say is you don't get both credits for the same dollar of tuition paid. So if you get the American Opportunity Tax Credit, that's a better credit. You would want to use the tuition for that credit. But the Lifetime Learning Credit you can get as well if you paid other tuition. So one or the other for any given dollar of tuition. The Lifetime Learning Credit is for anyone, so you don't have to be an undergrad or in your first 4 years of school. You don't actually have to be a full-time student for the American Opportunity. You have to be at least a half-time student. But you can get a credit of 20% of the first $10,000 of qualified education expenses that you pay. That again is tuition and required fees. In this case, it's not books and equipment, but just tuition and fees. Again, you can't claim this if you are a dependent of someone else, and there is that same kind of phase out if your income gets to a certain amount. All right. Again, you don't get these credits if you're paying the tuition, if the tuition's being paid by a scholarship or some other form of education expenses. I'm sorry, of tuition assistance. You actually have to pay these things. Paying them through a loan is considered to be paying them out of pocket. There are some tax planning potential things that you can do to kind of manage your taxes a little bit with this. So I would recommend maybe seeing a tax professional if you're in this situation, because sometimes um, you can earmark dollars as paying for certain things to maximize your situation. So maybe you pay more tax on your scholarships because you say it was paid it was paying your rent, and then you get a tax credit because you're saying you paid the tuition out of pocket. If you're paying both things, you can sometimes do that. So it's always best to get a professional involved if you're in that sort of a situation. All right, so an example. I think I've been seeing some questions in the chat about taxability of these things and credits, and we're going to kind of walk through an example that I hopefully will help. So if we have Sally, and Sally receives a $20,000 scholarship from the university, she's not required to perform any services. She's not a TA or an RA or anything like that. She just gets this $20,000 scholarship. She has $15,000 of qualified education expenses. So again, that is tuition, required fees, things like that. And she has $30,000 of living expenses. Again, that's her rent and her food and clothes. It's also things like traveling to a conference or paying for a subscription for a research, database or anything like that. Those are actually not qualified education expenses. So we've got $45,000 of expenses total. 20,000 of that was paid for by this scholarship. Okay. She's no other income. She's using savings to pay for everything else. Okay. So, first question, can Sally claim any education tax credits? And the answer to that is no, initially. She has paid the education expenses with this scholarship. And so she's not allowed to take any tax credits, right? She only had $15,000 of education expenses qualified, and she had a $20,000 scholarship. She doesn't get any tax credits. The truth is, she actually has $5,000 of taxable scholarship income. She has to pay tax on $5,000 of her scholarship because she only had $15,000 of qualified expenses, and so the other $5,000 was being used to pay for her rent or whatever it might be. No credits. Now, again, I said there is some opportunity to do some planning here where maybe she says, yes, actually, I paid for the tuition out of pocket and I paid for my rent with this scholarship. And then more of her scholarship will be taxable, but then she could get a tax credit. Sometimes that works out better. Again, that's more of an advanced tax planning strategy you might want to think about with a professional. Okay. This actually, I got ahead of myself, I guess. This walks through that situation where we say, okay, no, we're gonna say that she paid her education expenses out of pocket so that she can get this tax credit, and then that will mean though that she will have more of her living expenses that were paid for through the scholarship, and more of that's going to be taxable. Whether or not that's going to benefit her is going to be, that's a case by case analysis that you would have to do. All right, so that is filing your taxes in an hour and 12 minutes. So hopefully you've got it all down, but if not, we've got some resources here that you can use. All right, so to prepare your tax return, remember we said you had to prepare that Form 1040 at the end of every year. You're responsible for doing that. There are some ways that you can get help doing that. The IRS provides what's called free file. That's just access to a an online filing system that's fairly simplified through the IRS. You can do that as long as your adjusted gross income, remember that's your total of all your taxable sources of income minus a few types of deductions like traditional IRA contributions, and things like that. As long as that's under $79,000, you can file online for free through the IRS. The United Way also offers a My Free Taxes tool that is similar. I believe the income cutoff is the same for using the tool on your own, or they also can sometimes link you with someone to help you prepare your taxes, but the income threshold's less for that. There's also what we call VITA programs. We actually run one. The Geese College of Business runs one. We are going to start up the first week of February. That is located at Salt and Light at 1819 Philo Road in Urbana. The link is here to the website. You can get all the information. In the Chicago area, there's a program called Ladder Up that runs also a VITA site. VITA sites are IRS sponsored programs where volunteers can prepare your tax return for free as long as you meet one of the criteria. So your income has to be below, I believe it's $67,000 this year. You also have to be, you could have low income. There's three other ways you can qualify. If you're disabled, if you are over age 60, or if your English speaking is more limited, you can qualify even if your income is above those amounts. But the other caveat is your tax situation has to be fairly simple. You can't have a lot of complex things going on. But if you qualify, you can get your taxes prepared for free through one of those programs. One thing that people often ask is, let me take a step back too. I will say that the university provides a program called Glacier to graduate students that will allow you to prepare your federal tax return for free.
Mandy, I
Yes.
would just like to specify that is only for Urbana students. We have provided links to the Glacier software for international students at Urbana, but also I believe Tax is what Chicago and Springfield campuses are using to support their international student populations.
Perfect. Yeah. So there are resources through the university, and Andrea's provided you those links where you can do your tax return for free. Your federal return, your state return will require a small fee, but you can do that yourself through those programs. All right. So one last thing I think that we want to talk about just briefly is tips to avoid tax fraud. So tax fraud is a big issue. Tax fraud means typically someone has filed a tax return using your social security number to claim false tax credits, and it causes you heartache because then when you go to file your taxes, you can't get the tax credits you're eligible for because someone has already taken some credits. This is not as scary as it sounds. This is usually something that's fairly easy to iron out with the IRS, meaning you're not going to be out. They're not going to just say, bad luck to you. They're going to figure it out, but it causes a lot of headache for you. And so to avoid that possibility, one thing to do is to file early. So if you file first, your tax return is going to be the one that's on record. And so they're not going to be able to file a tax return using your social security number, and you won't have any issue. They're going to be the one, having the issue. Another way is to file electronically. That gets your return processed faster. If you file by paper, you can't get the that just takes longer for them to process and get into their system. I did see a quick question in the chat. What's the earliest I can file? I just saw that date the other day. I believe it's January 26th this year. You can request an IRS IP PIN. So sometimes the IRS sends these to people. If they've had their identity compromised, the IRS will send you one, but you can also request one yourself. If you request an IP PIN, then no one can file a tax return using your social security number without that PIN number. But just keep in mind, neither can you. So a lot of people request them and then forget that they have them. So you want to make sure that you keep that PIN number handy where you can find it. Filing a tax return, even if you don't owe tax, may help prevent fraud. So, for example, Social Security income recipients sometimes don't have to pay any tax. But if you file a tax return anyway, just reporting I have zero taxable income, that can preclude someone else from filing on your behalf. So some people like to do that anyway, not required at all, but you could do that. And then also you can always create an account online with the IRS so that you can check in on your account, see what's been happening, know if someone has filed a tax return or anything else through the IRS on your behalf using your Social Security number. You'll be able to see all that activity. All right. I think that's it for me. I'll hand it back over to Andrea, and then I'm happy to take any questions.
All right. Thank you so much, Manny, and thank you to those participants that are still here. We are recording this, so if you need to go somewhere, we'll send you the recording once it's made available. There were a lot of international students in the chat, self-identifying. If you are still confused, there's some unique aspects of taxes for international students. Manny's going to talk with us about next Thursday at the same time, noon, on January 23rd of 2025. So if you haven't registered for that already, please do so. Some things that we want to give you as takeaways, some action items. We want to help you with get organized, whether it's physically or digitally, get a folder together because you're going to start getting forms potentially from all these different income sources, and putting them together will help you when you go to file. You also want to download your Form 1098-T, which is already available. It's a secret. It's always available by the 31st, but University Bursar, who the Student Money Management Center is part of, has announced secretly to us that it's already available. So you can go check it out. You do that by logging into apps.uillinois.edu, selecting your campus, and then logging into student self-service that way. You can also, you'll be able to start downloading your W-2s pretty soon. You'll want to do that for any employment that you had during 2024. If you have moved on from a previous employer, you want to update your addresses with anyone that paid you during 2024. That includes not just employers, but any contracting entities. Maybe you worked for Uber or did DoorDash over the summer. Maybe you're retired and you need to update addresses from your pension payers, or any of the services associated with your retirement benefits. And then any financial institutions, if you have a brokerage firm that you work with, if you have a bank or credit union, you want to make sure that your addresses are all updated with those entities. If you're still here, if you can fill out the post-webinar survey, that will help us out, and it helps us plan for future years of these webinars. And you can also watch previous webinars, excuse me, on YouTube at go.uillinois.edu/get-savvy, or just search for IL Student Money. We post all of our recordings once they are captioned appropriately there. I'd also like to thank all of the collaborators for the Get Savvy webinar series, and there's a lot of us. And you might have noticed there were a lot of people responding to chat questions today. That is thanks to this collaboration. So now we're going to answer many questions, hopefully, that were put in the chat. I know, Kathy, you were keeping a list, so why don't you ask Mandi all the questions?
Okay, I have questions here, and some of them may just be that that's beyond the scope of what we're doing. Let's see. Do we have, well, there's been a repetitive question about do UIC employees have any service to fill our taxes? And I think maybe Andrea, you guys are investigating that.
For employees,
Yes.
none.
Okay,
Zero.
none.
Generally speaking, that's not a service an employer would provide to
Yeah.
you. You would seek a paid
Yeah.
like tax preparer to do that.
Do we have a resource we can suggest for navigating self-employment taxes?
You know, the IRS website is pretty good. They provide a lot of information on a lot of different topics. I'm sure they have a specific guide for that, but I don't know the number of that off the top of my head. Let me see if I can find it quickly. We could.
While you're doing that, Mandy, Steve Bob, who's here from the UIC Entrepreneur Support Program, one of our collaborators, he might have an idea. So, Steve, do you have any resources that you send to your clients?
In just a second, I'll put the website for the IRS. I believe it's called Self-Employed. I can't remember the exact name, but I will look it up and put it in the chat. That's always a good starting point.
Thank
Yes,
you,
that's
Steve.
exactly what I was looking for. So that's fantastic.
We just got a question in the chat. I'm a second year PhD student. First year I posted my tax forms physically through the mail. For the second year, should I file online or post the forms again?
I am assuming you're talking about Illinois taxes. So the first year you file in Illinois, if you do not have a valid Illinois driver's license, you have to file by paper. And then subsequent years you can file online.
Um,
I have a
if some,
clarifying question. Mandy, is it just driver's license or does state ID work?
State ID works as well.
Okay.
Mhm.
perfect. If I earn income from companies outside the USA, will I need to pay tax to USA or to the government of that country?
That depends on if you are a US citizen or resident alien, or if you are a non-resident alien. So if you are a US citizen, the answer to that is yes. If you are an international student and you are not sure if you are a resident or non-resident for tax filing, and again, that's different from your immigration status. We'll talk about all of that next week, but that will determine whether you pay tax on that to the US or not.
Great reason to tune in next week. Um, do standard deductions apply to stipend received through fellowship?
Yes, everyone gets a standard deduction. You just get one standard deduction a year. So, for example, if you had a stipend that you determined to be taxable, some of it was taxable, and that say that was $20,000 taxable stipend, and that's your only income, then you would reduce that, let's say you're single, by the standard deduction of 14,600, and you would pay tax on the 5,400 only. Everyone gets that standard deduction to offset their total taxable income.
If somebody has an IP PIN, but it doesn't authenticate properly, it fails. What should be their next step?
So my first step would be to set up an account on the IRS website. There is a Find My IP PIN number through that. So you have to set up an account, but you can retrieve your IP PIN by doing that. That'd be my first step, just to make sure that you have the right PIN number that you're using. And then if you're certain that you have the right PIN number, then I would talk with the IRS Taxpayer Advocate Center or the local IRS office, or calling the IRS and just asking those questions. But uh, there are often long waits when you're dealing with the IRS on the phone or in person. So the first step I would do is just make sure you have the right PIN number. The other thing I would say, and I don't know exactly what you mean by authenticate properly, but if you're talking about you're using some sort of tax software to file your tax return electronically and it gives you an error message, there are a lot of PIN numbers that are used for a lot of different things in some of those tax software packages. And so making sure that you're inputting the right PIN number in the right place is also a good troubleshooting tip. So identity protection PIN is a very specific kind of PIN number, and it would need to be put in a very specific spot. So for example, in TaxSlayer, which is what we use for VITA, there's a place to put a PIN number to agree to this sort of disclosure, and a different PIN number for the state of Illinois. And there are PIN numbers you put in a lot of different places. And so maybe you just have it in the wrong place in your tax software.
Good thought. I didn't think of that. Somebody else is asking for clarification. or restating maybe, as a graduate student that gets a tuition waiver due to being a TA, is that non-taxable?
It is. So there is a portion of that that is non-taxable. The amount is $5,250 a year that the university can give you as a tuition waiver without you having to pay tax on it.
Mandy, we actually have a whole video on that. So
Okay.
it depends on if they are a graduate assistant, pre-professional graduate assistant, teaching assistant, or research assistant. Teaching assistants and research assistants are explicitly excluded from that uh, taxability of anything over 5,250.
Okay.
Regular employees, graduate assistants and pre-professional graduate assistants, the tax liability applies as you're stating. Anything over $5,250 is taxable. So we have a whole page on our website specifically dedicated to it. So go to studentmoney.uillinois.edu. If you go to learn, there's a section called taxability of waivers. It's specifically dedicated to graduate students in your position.
Perfect. I'm going to go check that out too. I might learn something myself.
Excellent.
General rule, your employer can provide that, but it probably depends on your classification as what kind of employee it sounds like.
Absolutely. And every institution does it a little bit differently, and withholding is very unique at our institution because of how registration applies and how that is a factor in the withholding process.
Perfect. The other thing I will say though about being a TA and RA or such, the good news about that, if you're required to perform services in exchange for anything you get, then the university will provide you a Form W-2 telling you what is taxable. If you're not required to provide services, that's when you have to do some of the maintaining and tracking down those amounts that are going to be taxable.
Okay, if we're still going to take a few more questions, I have several in a row here about living in different places and where do we pay. So the first one is, if I work in another state for a couple of months, do I pay state taxes for that state and report it in Illinois somehow?
Yeah. So the answer is, if you are a permanent resident in Illinois and you go work in another state, then you will pay tax to that state on the income that you earned in that state. And then in Illinois, you will also report that as part of your taxable income, but you will get a tax credit for the taxes you paid to that other state. So you won't be double paying your tax. But it does work that way. It's a little different if you move from one state to another.
Okay, and if a PhD student has been living in Champaign for 3 years, are they a resident for Illinois taxes?
For Illinois taxes, you are a resident if you have moved your permanent residence here. So if you do not own a home somewhere else, you don't have a lease in another state, your mail is not going to your parents' house. There are a lot of different factors. There's no one factor. But if you so let's take two examples that are pretty cut and dry. Everything in the middle is, it's a gray area. So if you are an adult graduate student that had a home, maybe you were renting an apartment in Indiana, and you decide to come to the university for grad school, you're going to be here for 5 years. You give up your apartment in Indiana, you move all of your stuff to Illinois, you're now renting an apartment in Illinois. You are a permanent resident of Illinois for tax filing. If you own a home in Indiana and you're going to come to the university for 1 year for grad school, and so you keep your home, all of your possessions in Indiana, and you rent an apartment here for a year, your permanent residence has not moved. You are an Indiana resident who is here in Illinois for temporarily. You still have to pay tax in Illinois on any income you earn in Illinois, but you are not a resident. You are a non-resident of Illinois. It gets a little trickier when we're talking about you left some stuff at your parents' house, but you're really here and you're getting your mail here and your driver's license is here. That's a gray area. but the other two extremes are pretty clear cut.
I think we've got some questions about international students and residency. Are we going to be covering that
We'll
next
cover
in
that
the-
next week.
That's
Mhm.
what I thought. I think that is most of the questions.
Thank
That's it.
you. Thank you, Kathy, and thank you, Mandy, for being so generous with your knowledge and time today. We will also take any questions to the studentmoney@uillinois.edu email. So the same email address that sent you the login instructions for today. You can ask any questions there. The answers to those questions may be, I don't know, but here's the IRS website on that topic, or here's some additional information to help you find a tax professional that may be best able to answer those questions. But we'll do our best to support you. We know taxes are complicated, just like the rest of personal finance. We're going to wrap up today's recording, but we will send it out once it's captioned. It's been taking us a little bit longer to caption them for accessibility lately, but we're going to do our best to get it out in the next couple weeks. Thank you again for joining us, and have a wonderful rest of your day.